away with, I think, $25 the day after they reported earnings. But I had to go to September in order to even collect any premium. Otherwise, I was getting like $10 for the same Friday, and to me, that just was not worth the risk.
And why was that dynamic happening with them in particular? Because they just don't have as many options available.
Yeah, because they have monthlies, and there's just not a lot of liquidity on their options, I'm pretty sure. So prices tend to be a little bit lower. And since it was a monthly and it was the week of expiration, especially for that one, um, the prices just were lower than what I would normally look for the same week.
So speaking of liquidity, forget from what I'm understanding from what you're saying, stocks with higher liquidity are pretty much better plays to play in this strategy as opposed to stocks with lower liquidity because of the premium inflation, correct?
Yeah, so when there's more liquidity and all that, there tends to be more buyers in the market because when there's more buyers, there's just generally going to be more sellers. So you'll see more price fluctuations. So like when there's low liquidity on stocks, as you know, there tends to be huge spreads between the bid and the ask, and sometimes you won't be able to enter the position you want. Like I know for Chipotle, the spreads on those options are a few $100s, and by the time you might not get filled, and by the time what happens, what you want to happen in the stock, let's say you're playing a call, by the time the stock goes up, the premiums will just jump because there's not that much liquidity in it.
Got it. So on the flip side, that could also burn you as well, correct? Selling an option, right? Because you could end up selling it at that lower end of that premium spike.
Exactly, and then you'll see the always ugly paper losses in your account until it expires worthless.
Got it. But even in that case, like you said, all that matters is that it expires worthless. The paper losses are just
Yeah,
what they are. They paper losses.
yeah, and that's what happened to me last week with Zoom. If anyone follows Zoom, I think it tanked around 30% last week and went from 270, and on market open Monday. Well, it went from 270 the prior week. It opened around 254, I believe, on Monday, and I sold 230 puts right off the bat. I collected like $80 a contract, and then throughout the day it just kept dropping. It closed at like 235, or right actually 240. It closed right around 240, and then Tuesday at open, it tanked immediately. It smacked 230 on the dot. I got out for I think like an $800 loss. It smacked 230 exactly and just jumped right back up and didn't go any lower the rest of the week. So sometimes you'll panic like that, even when you're telling yourself it'll be fine, and your conscience will be right telling you to hold, but you panic because
as we all know, emotions that's the hardest part of the game. Like the psychology is the hardest part of the game, and no matter how long you've been trading, it's something that it's something that no one ever 100% masters. You just try to get better at it over time, but I don't think there's anyone that has like 100% mastery of their emotions when they're trading.
yeah, exactly. And I ended up panicking, taking the $800 loss, but fortunately I played Apple and Spotify the rest of the week, and I limited that. I think I was only down 200 on the week, so I ate into that quite a bit. But yeah, you have to be very patient with these because, like I said, paper losses will just, even though you know they mean nothing, just seeing your account down $3,000 on paper losses is just it just doesn't feel good.
So going back to this 9-0 earnings run, what were the stocks that you played, and did you play them all the same way how you did Spotify and Zoom, or did you on some of them you only did short puts, some of them you only did short calls? How did you approach the ones specifically in that 9-0 run?
So I played short strangles on every single one I played. Um, Let me look for the ones I did. I have to scroll back.
And
I
just
know
to
I played.
reiterate for those listening, the short strangles is what he did earlier with the short calls and the short puts.
Yes. So I played D Dog, The ticker's DDOG. I played Net Square. I believe, was PayPal earnings a week and a half ago, or was that earlier?
PayPal earnings? Nah, PayPal earnings was definitely earlier than that. It wasn't a week and a half
Okay.
ago.
Here, I can look this up real quick.
Yeah.
So I played. I got most of them now. So I ended up playing Roku, Etsy, Wix, Net, D-Dog. I played Square, Beyond Meat, Twilio, and and Chegg. I played Chegg as well. And I did short strangles on every single one of them, and every single one of them ended up hitting.
Now, for these short strangles, when you're setting your strike price for these short strangles, obviously we have them like far out of the money on each side. But are you using any particular, metric? Like they have, I'm gonna get the call 20% away from what the current price is, and to put, X amount. Is there any metric that you use? I mean, obviously these are pretty wide spreads for the strangle, so it's not like they're gonna hit. But I was just curious to know if you had any like set numbers that you use, or any type of guidance that you use in terms of where you set your calls and your puts relative to what the strike price is. I mean, relative to what the stock price is.
Yeah. So as I was saying earlier, there's this Twitter account that posts the implied moves on earnings for every stock usually reporting earnings.
Right?
Yeah, that account. And I look at the implied moves there, and then I add 15 to 20%, depending on what I'm more comfortable with at the time, to that implied move on the upside and the downside. And I'll try to go right around that implied move plus the 15 to 20% for my strikes.
Got it. Is there any, are there any metrics or guidelines in terms of what you think is an acceptable premium relative to the amount of risk you have to put up in terms of buying power? So, like, for example, on the Spotify, we know the risk reward ratio was you're collecting like $190 worth of premium on like $2,500 worth of buying power.
On Zoom, on Zoom, I wouldn't even say the buying power is risk. It is just the capital in your account.
I mean, technically, I have to say it's risk because technically it is, but it's like you said, it's really super, super low risk. And if it's hitting a put, you're
very low risk, and I just look at it as money I have to put aside for that certain amount of time that I can't use anymore until that trade is gone.
Because this is not like the other side of options where it can expire worthless or expire to zero. If it doesn't hit, you keep the premium.
Yeah, when you're going long on options, the only buying power requirement is the buying power it takes to actually buy the contract.
Exactly.
With short options, there's more buying power because if you get assigned and all that, it's just basically the brokerages covering themselves in case you can't cover the short position or the long position, depending on if you have a short put or short call.
Got it.
So I basically, I play 15 to 20% above and below the implied move based on earnings, and then if the IV is there, the IV rank is there, and then premium wise, I won't do something like you're making $30 to put up like 30 G's in buying power. Like, to me, that just doesn't seem worth it. I can get usually around $25 a contract on spot for $4,000 in buying power. And to me, I can just do multiple of those and make more than the $80, put up $30,000 in buying power.
Got it. So in general, most of these, and then for the runs you did after earnings week, did you play in the same way in terms of where you did the strangle, or did you have a different type of spread on them?
So for Zoom, I originally only did short puts, and then I panicked on those when it smacked the strike and bounced up. So I got out of those, and then I got back in Zoom, which is not something you normally want to do, but I went even lower. I went with 195 and 200 short puts, and then on the upside, I did like a 285 and 287 and a half short call for each of those short puts. So they were short strangles, but most of the time on just weekly non-earnings plays, I'll usually enter one side first and then enter the other side later.
And the reason that you're doing that is because entering the other side, you don't have to have much buying power because you already have a position on one side.
Yeah, exactly. Like if I start seeing the stock tick back up, if I have a short put and the stock's ticking back up towards where I'm looking for a call, I'll usually enter because usually on Spotify, if I have a short put, it only takes an additional $2 in buying power to add a short call.
Got it.
So to me, that is worth it because it takes very, very little buying power, and I'll collect another additional $15, $20, $30 a contract for 4 days.
Sounds good. So now, with this strategy, you've been doing pretty much strangles this entire time. For the people listening, are there any other spreads that you use often or employ often? I know a dude like you always are trying exotic spreads and all this other random crazy shit. But outside of the strangles, are there any other spreads that you're actually using on a regular basis?
So one of my buddies has an account. I think he put $300 in it, and I have him doing vertical spreads in there, which is you sell a put, and then you sell a put. The put you sell is closer to the strike, is closer to the stock price, and then you buy a put on the outside of that short put, and you make the difference in premium. And because of that, because basically you're hedging that short put with that long put, the buying power requirements are much smaller. I can pull up my buddy's account since he lets me look at the trades he takes. So he started this account with $300 just doing vertical spreads, and he's made $24. So because he only has $300, you're making a lot less money-wise.
Got it.
But so he currently has a vertical put spread on CyberArk, which is another company that a lot of us have been buying in the long-term chat. And so what he did is he sold a 103 put on CyberArk for August 21st. This was I think this was like 2 weeks ago he did it pretty long-term. And then he bought a 100 put. So the max downside on this is $300. It's basically his whole account value. And he's making $22, but because CyberArk is at like 110 right now, there's not that good of a chance that it's going to hit 103.
Now if it does hit 103, what would happen to his account now?
So if it hit 103 and it didn't hit 100, he would just be assigned on CyberArk at $103 a share.
Now if it does hit 100,
if it went in the money, he would lose $300 if he was assigned.
Got it. But doing the vertical spread, your risk is capped at the 300. Like your risk is capped.
Your risk is capped at the difference between the short put and the long put strike prices.
And his upside is capped as well when you're doing a vertical spread.
Yes, because at least on this vertical spread, because it's a credit spread, which credit means you're collecting the premium, opposed to a debit spread, which would be you're buying the premium. On credit spreads, the upside is capped.
Got it. So I just wanted to clarify for people, so they kind of just understand when you're playing this side of the game. The risk is limited, but also the risk are extremely limited, but also the upsides do have caps when you're playing these most of these spreads. Are there any spreads where your upside is unlimited?
If you do debit spreads, yes. Otherwise, no. So like you can do, like for example, we'll use Apple as an example. Let me set that up real quick on Tasty Works. You can do a long put spread. So basically, the example they're giving